And for a closer look at the jobs picture and what the Fed likely watching, let's bring in Julia Coronado, former Fed economist. She's now president of Macropolicy Perspectives, and Michael Strain, AEI Economic Policy Studies Director. Julia, are you heard the three things I just checked off. Is it the start of what the Fed has been trying to orchestrate in the labor picture, in your view?
I mean, definitely, we're starting to see many indications of weakening labor demand. It's not just layoff announcements. It's a lot of companies across the board reporting reduced hiring plans. It's the indicators you mentioned. So, yes, we are seeing reduced labor demand. We are seeing better labor supply. We have seen wage growth moderating pretty steadily over the last few months. So it is exactly the picture that the Fed has been trying to orchestrate. It remains to be seen whether this will be enough because, of course, inflation hasn't yet shown the same kind of progress or softening that the labor market data have seen. So we'll see how they square this circle. But it's definitely clear across the range of labor market indicators that that better balance between demand and supply is close at hand.
You agree with Julia's analysis there, Michael? And can you explain why yields are where they are? Take your pick, 10-year, 2-year, wherever. Where do you want to start?
Yeah, so I basically agree with Julia. Julia emphasized the kind of trends in labor demand and labor supply. I think my emphasis is still more on the levels, and the gap between them is very large, and surely was very large last month as well. We may see some softening in the number of jobs that were added to the economy last month. Maybe we'll see a slight uptick in the unemployment rate. But the kind of fundamental picture, I think, still will be of an economy where the demand for workers is well in excess of the supply of workers, where we have seen over the last year, 18 months, a kind of gradual softening in the labor market. Remember, last summer, we were adding over 400,000 jobs a month on kind of a 3-month average basis every month. This summer, maybe it's above 250,000 or something like that. But that kind of softening has been in place for a while if you zoom out and look at the longer trend. But where we still have a labor market that's much too tight, and that is producing wages that are growing at rates that are much faster than are consistent with underlying productivity and with the Fed's inflation target. The one area I would differ with Julia. I think if you look at wage growth among the industries where inflation really is a problem, right? Core services, excluding housing services, there you haven't seen a softening. Wage growth among workers in those industries has been quite steady for many months and way too high relative to the Fed's target. And so my kind of baseline view, even if we see some softening, even if the number comes in at 275 tomorrow, 275 net new non-farm payroll jobs added, I think my baseline takeaway is still going to be that that interest rates have to go up higher than markets expect, and that in order to get inflation down, we're going to have to get wage growth down. In order to get wage growth down, we're going to have to see a pretty big increase in the unemployment rate.